Hello friends, Christian Carter from Radius Financial Group, and in this video we're talking about non-purchasing spouses, we're talking about community property states, and we're talking about FHA loans and what all three of those have to do with each other and why it's important. So let's get right into it. All right, so up here first, right, what is a non-purchasing spouse? Well, just like it sounds, it's essentially a spouse who is not included on the mortgage loan application when purchasing a home. Right? Now, the reason why the spouse might not be included, some obvious reasons like they might not have enough income, they might have a lot of debt, which will drag or which will push your debt to income ratio up. They might have bad credit, anything like that. So it's basically a spouse that is not going to be on the mortgage with you when you buy a home, right? Now, why does this apply to FHA loans? Well, it applies to FHA loans when we're talking about a community property state, right? So essentially, any debts incurred during the marriage are considered joint debts when it comes to a community property state, right? Now, why we care about it for the FHA loan is that essentially the FHA loan requires the debt of a non-borrowing spouse to be included in the mortgage application if one of these two things are true. If the non-borrowing spouse or non-purchasing spouse currently resides in a community property state, or if the property being purchased is located in a community property state. All right, do not worry if you were a little bit confused by that. We're going to go over an example and it is going to be crystal clear because I love examples in these videos, right? But before we get to that, I'm sure you're wondering what states in the United States are actually community property states. Well, there are 9 of them, right? So you've got Arizona, California, Idaho, Louisiana, I hope I spelled Louisiana right, Nevada, New Mexico, Texas, Washington, and Wisconsin, right? So those are the 9 community property states within the United States. Now, let's go over that example that I promised, right? So let's look at this example that we have right here, right? Let's go over example 1. The non-borrowing spouse resides in California at the time of application, which of course is a community property state. And the new primary residence, the one that they're buying, is in Georgia, which is not a community property state. In this example, the non-borrowing spouse's debt must be included in the qualifying ratios because even though Georgia is not a community property state, the state that the non-borrowing spouse currently lives in is a community property state, so that's why we need to include their debts in the qualifying ratios. All right, so now let's look at example 2, right? So in this example, the non-borrowing spouse resides in New Jersey at the time of application, which of course is a non-community property state. And the new primary residence, the one that they're buying, is located in Texas, which is a community property state. So again, in this example, the non-borrowing spouse, their debt is going to be included in the qualifying ratios because even though at the time they don't live in a community property state, the home that they're buying is located in a community property state. All right, I hope you did like the video this week. If you did, I would love it if you can give it a big thumbs up. Most importantly, if you have topics for other videos, please leave them in the comments below. You guys know I love making these videos. And then if you do tend to enjoy most of my videos, I would love it if you could subscribe. That way it really helps my channel out. Other than that, keep the questions coming and I will keep the videos coming. Thanks. See ya.